Tom Lee, Fundstrat Global Advisors, managing partner and a CNBC contributor, but close enough for government work. You're right again. And once again, your rationale was borne out. It was that inflation would continue to cool. It's July 1st. You have a new target for the end of the year, or I've already sort of foreshadowed some of the things you were talking about. The S&P earnings might even be above what you thought.
Yes, I think that now that we're at the mid-year, 2025 earnings look a lot stronger than we thought at the start of the year. We thought maybe 260. It's probably closer to 275, maybe 280, even 285. And I think the multiple we thought originally could be 20 times that number for next year. But given the Fed has more reasons to be dovish, and I think maybe the employment picture is softening, PE multiples actually could be higher next year. So I'd say between now and year end, stocks should be higher. I mean, we've had a strong first half already, and second half won't be as strong as the first half, but we should build upon those gains. So yeah, it looks pretty good.
You have numbers. I mean, so if the S&P is 285, you possibly, that's earnings,
correct,
285, up from 270. Because the economy doesn't cool, multiples don't expand. In fact, they might contract from 21 to 20. So if you multiply 20 times 285, you get to 5,800.
Yeah, so that sounds like it would be within as a reasonable base case, that stocks don't have to have a prodigious second half. They just have to follow what typically happens in the second half, especially in an election year.
So 5,800 for the year, what would that be the total return? If it's 15 now, so
so it's it's a little bit more than 20%,
which would be after last year's
24.
That's a couple years no one really expected, I don't think.
That's right. I mean, that's painful for people who've been sitting in cash for 2 years, earning 5% because they missed out on a 50% gain, and that's 10 years worth of sitting on cash. So I think the end of this year is a little bit of a day of reckoning for those who've said, "Oh, I'm happy with my $6 trillion in cash, earning 5%," when in reality, unless the economy is rolling into recession, the expansion will continue for some time.
Is the $6 trillion, and that's what's fueling this, the additional liquidity, people aren't fully invested, was that gotten through organic positive means, or was it gotten through stimulus that shouldn't have been probably legislated and shouldn't have been printed? Is it good money, or is it money that comes home to roost because it's too much?
I haven't deconstructed that, but it's a valid point because we are running a pretty big fiscal deficit at a time when it's not necessary. There is a lot of earned income on people's assets. I think that accounted for a lot of this increase in cash. And historically, that would have been reinvested in the economy or into equities, but it's been instead earning cash.
You know that my insecurity about crypto manifested itself again in my feet of clay because I said, Tom Lee's going to be absolutely right about the 5,500. Why is he still saying 150 for Bitcoin? Why do that? Why not just focus on stock? Don't stick your neck out because it was falling below 60,000. Now it's back to almost 63,000. So that $6 trillion we just talked about, that sort of plays into your Bitcoin thesis.
That's right. Bitcoin's probably suffering from the Mt. Gox, starting distributions in July. That was a huge overhang for many years. But if I was invested in crypto knowing that one of the biggest overhangs is going to disappear in July, I think it's a reason to actually expect a pretty sharp rebound in the second half. So I think 150 is still within.
It's already July 1st, so that's so you're not taking that off the table. That's still a possibility.
That's right. And one thing to keep in mind, Bitcoin makes most of its gains with 10 days every year. If you take out the 10 best days in a single year, Bitcoin actually has negative return.
So let me know what you think about Tom Lee's prediction down below in the comment section. I do think as long as the US economy avoids a recession, which is a question that we don't have answers to, Tom Lee's probably correct in his 5,800 prediction by the end of this year for the S&P 500. But if the economy weakens and gets worse from here and expectations for a recession rises and EPS estimates fall for 2025, then we're not hitting 5,800. We did get some data out this morning that suggests inflation is falling in the manufacturing sector. And we will get a speech from Fed Jerome Powell tomorrow that could be either really good or really bad for markets and jolts job openings, which will give us a clear and concise understanding of just how strong the labor market actually is. At 10 o'clock in the morning Eastern Standard Time today, we had ISM manufacturing PMI that came in at 48.5. The estimate was 50. So anything above 50 is positive or expansionary. Anything under 50 is contractionary. So manufacturing is still in contraction. ISM manufacturing employment came in at 49.3. We were expecting 51. So both of these numbers missed expectations. ISM manufacturing new orders came in at 49.3, beating the estimate for 46. Still in contraction, but not as bad as we thought. And ISM manufacturing prices came in at 52.1. We were expecting 56. So the inflation component of your manufacturing PMIs came in really good today. Construction spending month over month, on the other hand, last month was at negative 0.1%. Month over month, it was revised up to positive 0.3%. So this month's data, or for the month of May, was negative 0.1%. We were expecting positive 0.1%. So that was actually a net positive if you include last month's revision to construction spending. So that's slightly inflationary, but your prices falling more than expected definitely more than offset that. What's most fascinating about today and what's happening in our markets is you actually have the 10-year treasury yield that's up 13 basis points. That is half of a rate hike or rate cut typically from the Fed, which is 25 basis points. So moving up 13 basis points in a day when you actually had good data on inflation does not make a whole lot of sense, and it is stumping Wall Street. 10-year treasury yields are currently at 4.473%. I will offer some insight to what could be happening with 10-year treasury yields today. We do have a speech from Fed Jerome Powell coming out tomorrow at 9:30 in the morning, right as markets open. And I think bond investors, either they have the speech information before we do, and maybe that is why bonds are rising today. That's more of the tinfoil hat version to what's happening in bonds. Or you could just say it's kind of a lead up into Powell and people are positioning for a more hawkish Jerome Powell. I have had quite a few of you guys in the comment section talk about oil that has rallied from about $70 a barrel up to $80 a barrel in just the month of June, which is an increase of about 15%, which could add to inflationary pressures and maybe lead to a more hawkish Powell. You also have the Bank of Japan that could be adding to some of the selling in U.S. Treasury markets, causing 10-year Treasury yields to rise. Japan is the single largest owner, at least foreign owner, of U.S. Treasuries. And they currently own over $1.2 trillion worth. And it is rumored that the Japanese central bank is going to step in and slow down the bleed out of the Japanese yen relative to the dollar soon. JOLTS job openings are expected to come in at about 7.9 million. Last month, you were at 8.059 million. So you are expecting about 105,000 jobs will no longer be available to be filled from last month. Now, keep in mind, when I say last month, you're actually talking about March, and now you're looking at May's data. So you're pretty far behind. This is not June's data. This is for the month of May. Now, think about it like this. If you are a company and you are looking to hire 10 employees, you're probably doing just fine. If you're a company and now you're only looking to hire 5 employees, you're probably not doing as good. So as the job openings fall and there's less positions that need filled, that's a sign that the economy maybe is not doing as good as expected. So with the JOLT job openings, if you come in really low tomorrow, that's a sign of economic pain. If you come in on the higher side and there's more job openings than expected, that's a sign that there's more hiring that needs to be done and the economy's probably doing just fine. So actually the JOLTS job openings will give us a pretty good indicator of how good the economy is doing and how strong the labor market is. Also worth mentioning today, this is not a broad-based market rally today, even though some stocks are up quite a bit. The NASDAQ is up 0.66%. The Russell, on the other hand, is down over 1%. The S&P is up 0.2%, and the Dow is up 0.13%. So still, as we head into today, the start of the second half of 2024, and seasonally the best 2 weeks of any year being the first 2 weeks of July, with an average return of over 2% for the S&P 500, you're not seeing everything participate. In fact, you're seeing small caps sell off and the S&P not doing much of anything. And I do still strongly believe if we don't enter into a recession, if the economy continues to hold up, then you will see a broadening out of our markets. And you're simply not seeing that today. So in other words, I think it's inevitable that you see a broad market-based rally or you see a full-blown correction and or crash. But what I'm confident in is that you're not just going to see Mag 6 or Mag 7 stocks continue to drive the markets higher and higher throughout the second half of this year. You will see that break for better or for worse. Game of Trades on X says consumer defaults have hit the highest level since the financial crisis. They add, this won't end well. The Kobisi letter on X says this. They say, what just happened in the bond market? The 10-year note yield is up over 20 basis points since Friday's intraday low. That's 20 basis points in a matter of hours without any material news. For the first time in almost 5 weeks, the 10-year note yield is set to break above 4.5%. The bond markets are trading like rate cuts got canceled and inflation is on the rise. Are bond markets telling us something? Now, what's interesting about the bond market is the US bond market is about 2 to 3 times larger than the stock market in total value. So what that means is usually when bonds are doing something different than stocks, it's telling you that bonds are usually right. That's why it usually pays to pay attention to bond markets. And that's exactly it. Bonds now are telling us inflation is on the rise. The Fed is not going to be cutting rates anytime soon. Heading into a speech from Fed Jerome Powell coming tomorrow, maybe bond markets are telling us we're going to get a pretty hawkish Powell. And unfortunately, judging off of the rise in the NASDAQ, S&P, and the Dow today, going against what the bonds are doing, I don't think that sets us up well heading into tomorrow. You could also make the argument that maybe the bond market is revolting a little bit about a potential Trump presidency, that could cause a little bit more inflation, although I think it's a little early for that. Seth Golden says small caps are cheapest they have been since the .com and 2020 pandemic. EPS is forecasted to explode higher in Q2 after 5 quarters of declining EPS. Do you think they will remain this inexpensive on absolute and relative basis? Let me know what you guys think about that down below in the comment section. You're actually expecting almost 14% EPS growth for Q2. Q3, 35.3%, and for Q4, the last quarter of this year, you're expecting 54.8% growth, and then Q1 of 2025, you're expecting 36.3% growth, and then Q2 of 2025, you're expecting 40.8%, and then Q3 of 2025, you're expecting 27.9%, and then even the last quarter of 2025, Q4 of 2025, you're expecting 23.1% EPS growth. These are not just, a 1 or 2 quarter kind of elevated expectations. This is the next, almost 2 years that we're expecting EPS growth will well outpace the S&P 500. And Dietrich points out on X, the first trading day of July has been higher the past 13 years in a row and 18 of the past 19 years. Zero Hedge on X says ISM prices suggest CPI is set to drop to 2% or less. Ryan Dietrich points out, as many have noted, the first half of July is usually pretty strong, but looking at why, it isn't because it has a bunch of great days, but a lack of bad days. The US bond market has now been in a drawdown for 47 months, by far the longest bond bear market in history. And you can see that here represented with TLT. This is what is adding to all of the bank's unrealized losses. JP Morgan's Marko Kolanovic warns yet again today the S&P 500 will plummet 23% by year end, and they reiterate their 4,200 price target for the S&P. Seth Golden writes on X, while breadth of the SPX S&P 500 rally has been narrowing, the percent of S&P companies with positive 3-month percent changes in forward earnings has been increasing. The latter was up to 83.2%, and the highs typically result in a broadening of the market rally and small and mid cap rotation. And that's what it looks like here on the charts, with the red shaded areas being recessions. When you tend to see this blue line rise, you do tend to see, a broadening out of the markets, like you've seen back here with 2020. You had a, broadening out of the markets throughout 2021, and everything kind of participated. The great Martis on X says worsening. This is not good. This is very bad, and shares a picture of global bond markets with the 10-year Treasury yield up 2.3%. You have Australia's yields up. You have Spain, Germany, France's yields up. Basically, across the board, across the world, you're seeing bond yields going higher. Sven Hendrick on X says, wild, consumer sentiment is lower than during the bottom of the COVID crash. And that's with markets near all-time highs and unemployment at 4%. It speaks to the big bifurcation in the economy, as the rich have gotten richer again while the majority is feeling pain. This even comes as Germany's inflation rate slows more than expected to 2.2% year over year in June, from 2.4% in May versus the 2.3% estimate. Core CPI drops -3%. Sub 3% for the first time since February of 2022. Again, I just want to highlight, with bond yields doing what they're doing today, it really just makes you wonder what in the hell is going on that we do not know about. A 13 basis point move higher in the 10-year Treasury yield happens after a really bad CPI day, a really hawkish Fed, like a major event, and you actually got good news on inflation today. So I would expect we get clarity and answers to just this coming tomorrow with the speech from Fed Jerome Powell. If I do want to think logically about this, there's something big coming from Powell tomorrow. Maybe the JOLTS job openings come in really high. Maybe we don't continue to see more progress on inflation. Something is happening, and we just don't know of it yet. And that is what has me a little concerned, especially given the markets are actually going higher today, with the S&P and the NASDAQ, as well as the Dow, the Russell, not playing along. That's usually not going to end well. Again, even to validate this point that I'm making even more, we did get a new Atlanta Fed GDP Now estimate for Q2 GDP this morning that plummeted from about 2.2% down to 1.7%. This should not cause bond yields to rise. In fact, this means we're getting closer to a official recession with contractionary GDP. This should actually be having the effect of causing bond yields to fall. But yet you're actually getting a lower probability of a cut coming July 31st, 2024, now only at 7.2%. Just on Friday, you had a 10.3% chance of a cut. And again, the data today would suggest that you should probably get a cut sooner, not later. You shouldn't be pricing out the chance of a cut by July 31st. You should be pricing in a greater chance of a cut July 31st. Based on the data that we got today. Option activity today via the interesting flow sentiment over on Ortex is tracking 53 different trades totaling $22.5 million with a positive order value of 34%. For this Friday's option expiration for the S&P 500, the SPY ETF, you have volume today of 50.43% calls and 49.57% puts, which is split almost exactly 50-50. You do have 30.4% of the open interest being calls calls and 69.6% of the open interest being puts. So you do have about 2.3 times as many puts compared to calls on the S&P for this Friday's expiration. And yet again here today, you are seeing a collapse under the surface of our markets, with almost 5% of all stocks out there breaking under their 50-day moving average. That is down by almost 11% today, down to 39.83%. So you firmly have about 60% of stocks currently in a pretty severe downtrend. Again, we will have to wait and see what happens, but now 10-year Treasury yields are up almost 14 basis points, and this is the biggest quote-unquote red flag that you could get ever, that something is not quite right. So go ahead, hit the like button, subscribe to the channel if you want to stay informed of what's going on in our markets. This bond market blowout that you are seeing today for no real reason, again, reminiscent of something you would see with a hotter than expected inflation report, Jerome Powell coming out, being super hawkish or something along those lines. But you're not getting any of that today. You actually had prices paid that eased in your manufacturing data and construction spending that came basically in line with estimates, suggesting maybe just an overall weaker economy, with Atlanta Fed GDP now estimates actually falling for Q2 GDP. None of this makes any sense. And if you want to stay up to date in all of this information that doesn't make any sense, hit that subscribe button. We will do our best to break this down and put it into context. Again, my final conclusion is there's a reason that 10-year Treasury yields are up 14 basis points today. That's not a small move. That's a huge move, a massive move. And that means we are going to get some new information pretty soon, and it's not going to be good. It's going to be Powell being very hawkish tomorrow. It's going to be inflation pressures coming in hotter than expected. I'm not exactly sure, but I would argue it's probably because Jerome Powell is going to be a little hawkish coming tomorrow. Let me know what you think about all of this information down below in the comment section. Hit the like button, as well as, again, subscribe to the channel. You guys have a fantastic rest of your day, and I will see you in the next one.